There is a pattern buried inside every financial catastrophe in human history. Not hidden in the numbers. Not concealed in the contracts. Hidden in plain sight, in the behavior of ordinary people doing what seemed, at the time, entirely reasonable. Every generation believes it has finally escaped this pattern. They look back at the disasters of the past and shake their heads. They call those people naive, uninformed, reckless. But remove the surface details, the specific asset, the specific era, the specific technology, and what remains is always the same sequence. The same psychology. The same result. This is not a story about greed. It is a story about incentives. And incentives, unlike morality, are predictable. Before there were stock exchanges. Before there were central banks. Before the word crisis existed in the financial vocabulary, the cycle was already turning. Quietly. Patiently. In ancient Rome, wealthy landowners borrowed heavily against their estates to fund expansion. Credit was not seen as dangerous. It was seen as leverage, a tool that transformed ambition into action. And for a long time it worked. Land prices rose. Rents increased. The returns justified the debt. The system appeared stable because, from the inside, it felt stable. But stability built on borrowed confidence is not stability at all. It is a surface stretched thin over a void. When political instability disrupted trade routes in the late Roman Republic, the credit markets froze. Loans were called in. Assets were sold at whatever price the market would bear, which was far less than anyone had imagined. Fortunes that had taken decades to build vanished in months. Small farmers lost their land. The wealthy absorbed the wreckage at a discount. And when the dust settled, the cycle began again. Slightly reconfigured, but structurally identical. Medieval Europe repeated this story with remarkable precision. Expanding trade networks required credit instruments. Credit instruments encouraged speculation. Speculation generated returns that attracted more participants. The more participants, the more confident the market felt. The more confident the market felt, the more credit was extended. And somewhere in this loop, always, the point of no return was crossed. Not with fanfare. Not with a warning bell. With a single missed payment. A single rumor. A single moment of doubt. This is the first uncomfortable truth. Financial cycles do not begin with madness. They begin with opportunity. And opportunity, by its nature, is impossible to resist. In 1637, a single tulip bulb sold in Amsterdam for an amount equivalent to a skilled craftsman's annual salary, multiplied by 10. This was not an isolated act of lunacy. It was the logical conclusion of a market that had been rewarding tulip speculation for years. Early buyers had made fortunes. Their success attracted new buyers. New buyers drove up prices. Rising prices attracted even more buyers. Each new entrant had evidence, real, recent, undeniable evidence, that the market worked. The tulip mania is remembered as absurdity. But in the moment, it followed a perfectly coherent internal logic. The people buying tulip contracts were not fools. They were doing exactly what the system was incentivizing them to do. They were following the money. And the money, for a while, followed them back. What broke was not reason. What broke was consensus. On a single February morning in 1637, buyers stopped appearing at auction. No one announced a crash. No report was published. The confidence simply shifted. And in the absence of new buyers, the entire architecture of expectation collapsed. Within weeks, bulbs that had sold for fortunes were worth almost nothing. Contracts became unenforceable. Fortunes evaporated. What the tulip mania teaches us is not that people are irrational. It teaches us that markets are social structures. They function on shared belief. And shared belief, unlike arithmetic, can change direction overnight. Every major financial expansion in history has been powered by the same engine: leverage. Borrowed money amplifying returns. This is not a flaw. In moderation, leverage is how economies grow. It is how a merchant with limited capital can outfit an entire trading ship. It is how a young entrepreneur can build something larger than their personal savings would allow. But leverage has a hidden cost. It compresses time. Gains arrive faster. And so do losses. During the South Sea Bubble of 1720, English investors poured money into a company that had, quite literally, no viable business plan. The South Sea Company promised to take over British government debt in exchange for a monopoly on trade with South America, trade that, at the time, was almost entirely controlled by Spain. The scheme was financially incoherent, but the stock price tripled in months, then quadrupled. Because when prices rise fast enough, people stop asking why and start asking how much. Isaac Newton himself invested in the South Sea Company. He sold early, made a modest profit, watched the price continue to rise, bought back in at the top, and lost the equivalent of millions. After the crash, he reportedly said that he could calculate the motion of heavenly bodies, but not the madness of people. What he was actually describing was not madness. It was the mathematics of momentum, a force that feels identical to fundamental value right up until the moment it stops. The South Sea Bubble cost thousands of investors everything. It nearly destabilized the British government. And it produced the first modern financial regulation, the Bubble Act of 1720, which attempted to prevent similar collapses by restricting the formation of joint stock companies. The regulation was well-intentioned. It was also, in the long run, completely ineffective, because the architecture of Euphoria does not require a specific vehicle. It only requires a specific feeling. If euphoria is slow and social, panic is fast and electric. A financial panic does not spread like information. It spreads like fire. And like fire, it does not require a large spark, only dry conditions. In 1907, a failed attempt to corner the copper market triggered a banking panic in New York that threatened to bring down the entire American financial system. Banks stopped lending to other banks. Depositors lined up around the block to withdraw their savings. Credit, the invisible circulatory system of the modern economy, stopped flowing. And when credit stops, everything stops. What prevented total collapse in 1907 was not the government. The United States had no central bank at the time. What stopped the panic was a single private individual, J.P. Morgan. He locked the heads of the major New York banks in his library and refused to let them leave until they had collectively agreed to inject enough capital to stabilize the system. It worked barely. The 1907 panic led directly to the creation of the Federal Reserve in 1913. A private crisis produced a public institution. An emergency measure became permanent infrastructure. This is the consistent historical pattern. Crises do not just destroy, they construct. Every financial catastrophe leaves behind new rules, new institutions, new frameworks. The question is never whether those frameworks will eventually be tested again. It is only when. The most treacherous phase of any financial cycle is not the crash. It is the calm that follows. In the years after a crisis, memory is vivid. Caution feels earned. Risk feels dangerous. The rules written in the wreckage of the last collapse are followed carefully, at first. Regulators are vigilant. Investors are conservative. The language of restraint dominates public discourse. But slowly, almost imperceptibly, the temperature changes. The crisis recedes in the rearview mirror. A new generation enters the market with no personal memory of the collapse. The rules that were written to prevent a recurrence begin to feel like obstacles to growth. The protections start to look like excessive caution. And the incentives, the fundamental, structural incentives that reward participation and punish hesitation, begin pulling in the old direction again. This is not weakness. This is not ignorance. This is the system functioning exactly as designed. Markets are built to allocate capital toward perceived opportunity. When opportunity reappears, as it always does, capital follows. And with capital comes confidence. And with confidence comes credit. And the engine starts again. There is a version of financial history that presents these cycles as problems to be solved. If only the regulations were tighter. If only the investors were smarter. If only the governments intervened sooner, or later, or differently. But the deeper reading of the record suggests something more unsettling. The cycle is not a malfunction. It is a feature. It emerges from the same human capacities that build economies in the first place: ambition, optimism, the willingness to take risk in pursuit of a better outcome. You cannot remove those qualities without removing growth itself. What history actually teaches is more modest and more useful. It teaches pattern recognition. It teaches the difference between confidence and certainty, between leverage and stability, between a market rising because value is being created and a market rising because everyone expects it to keep rising. It teaches that the moment a financial narrative becomes universally accepted is precisely the moment it should be questioned. Not because the narrative is always wrong, but because universal acceptance is itself a warning sign. Bubbles do not form in secret. They form in public, celebrated, justified, and endorsed by the most credible voices of their time. The cycle will continue long after every individual investor currently active has come and gone. The only real variable is whether you understand where you are inside it before the market announces the answer for you. History does not punish ignorance. It simply charges interest. If this gave you a new way of seeing the relationship between money, power, and time, subscribe to the channel. History holds the answers. I'll show you where to look.